Welcome to The Explainer. All right, today we're going to tackle one of the most powerful and honestly most misunderstood forces in our economy: interest rates. Yeah, they touch everything: your mortgage, your savings, and by the time we're done here, you'll see exactly how it all works.
So let's start with a question that, probably hits close to home for a lot of us. Have you looked at your mortgage statement, your car loan, or your credit card bill lately and just thought, wow, this is getting expensive? Well, you're definitely not alone, and guess what? There's a really clear reason why, and we're about to dive right into it.
Okay, so to get to the bottom of this, we've got to grasp one really simple idea. Borrowing money is never free. Think about it. You pay for pretty much everything else, right? Groceries, gas. Well, money itself has a price tag.
And that price tag is, you guessed it, the interest rate. It's really that simple. It's the cost you pay to borrow money. But here's the other side of the coin. It's also the reward you get for saving it. When you put money in the bank, they're basically paying you to use your money.
And what's so wild is how this one single percentage point creates two totally different worlds, right? When rates are high, it's tough if you're a borrower. Everything costs more. But if you're a saver, it's fantastic. Your money is making more money for you. And when rates are low, boom, the whole thing flips. It's like this constant economic seesaw. So who's in charge of this price? Who's setting these rates? It's not just some random number, that's for sure. There's a major player behind the scenes, kind of pulling the levers for the whole economy.
And here in the US, that powerful institution is the Federal Reserve. You've probably heard of them as the Fed. They have this incredible influence over the entire economy, and their number one tool is something called the federal funds rate. Now stick with me here. This is the rate banks charge each other for super short-term loans. And why does that matter to you? Because that one rate sets the stage for basically every other interest rate out there.
So you can see how this creates a domino effect, right? The Fed makes a decision that changes the cost for banks to borrow money from each other. And then the banks turn around and adjust the rates they offer you and me. So a tiny little tweak at the very top of the system, well, it ends up creating these huge waves that wash over all of our finances.
Okay, so that brings up a huge question. Why is the Fed even doing this? Why are they changing rates at all? Well, it's not just on a whim. They have a massive job to do. Basically, they're the guardians of the U.S. economy's health.
And their biggest fight, the thing they are constantly battling, is against one public enemy number one, an economic force that affects every single one of us, every single day, by eating away at the value of the money in our pockets. And that enemy is, of course, inflation. You know what this feels like. It's when the price of everything, groceries, gas, rent, just keeps climbing and climbing. When that happens, when your dollar just doesn't buy what it used to, the Fed has to step on the brakes. It's their main job.
Okay, if there's one thing you take away from this whole explainer, let it be this analogy. Seriously, think of interest rates as the gas pedal and the brake pedal for the entire U.S. economy. It's the perfect way to understand what the Fed is doing. They're either trying to speed things up or slow things down. So when the economy is overheating, when inflation is out of control, the Fed slams on the brakes. How? They raise interest rates. That makes it more expensive for you to get a loan, for businesses to expand, so everyone starts to spend a little less. That cools down demand and, fingers crossed, brings those prices back down to earth.
And on the other hand, what if the economy is stalling out? If we're worried about a recession? That's when the Fed hits the gas. They cut interest rates. Suddenly, borrowing is cheap. It encourages all of us and businesses to spend and invest, which hopefully gets the economic engine roaring back to life.
So now you see the big picture. One move by the Fed. It's like dropping a stone in a pond. It doesn't just make a splash where it lands, it sends these ripples out that touch every single part of the economy. And that means they affect nearly every big financial choice you're ever going to make.
And I mean, look at this list. We're talking about huge stuff. Mortgages and the housing market, your credit card debt. Suddenly that balance is growing way faster. Car loans, business investments, which affect jobs, even the stock market and the value of the US dollar on the global stage. Literally, nothing is immune.
Let's take housing. This is a huge one for so many people. A jump in interest rates can easily add hundreds, even thousands of dollars to your monthly mortgage payment. That's enough to completely price people out of buying a home. And that doesn't just affect buyers and sellers. Think about real estate agents, construction workers. The whole industry feels it.
And this number, 25% plus, that's not a typo. That's what your credit card APR can soar to when the Fed is hiking rates. All of a sudden, any debt you're carrying becomes a much heavier weight because the interest is piling up so much faster. You might think, okay, but my investments are safe, right? Well, not exactly. When rates go up, it gets more expensive for companies to borrow money to grow their business. That can squeeze their profits. And when Wall Street thinks profits are going down, well, stock prices often follow suit. So yeah, even your retirement accounts feel this.
Okay, so that's all the how it works stuff. But the big question is, what does this actually mean for you? How can you use this information to make better decisions with your own money? Let's break it down into a simple, practical guide.
This chart right here is basically your playbook. Look, when rates are high, what's the smart move? It's tough to borrow, so maybe you focus on aggressively paying down that high-interest credit card debt. And it's a great time to save because your money's working harder for you. But when rates are low, the whole strategy flips. It's cheaper to borrow, so maybe that's the perfect time to finally get that mortgage or car loan. See, this is what I mean. Understanding how interest rates work, it's not just some boring economic theory. It's a genuine superpower. It lets you look at the headlines about the Fed and know exactly what it means for your wallet. It helps you decide when to save, when to borrow, and how to plan for the future.
And that leaves us right here, with the huge, constant challenge the Fed is always facing. It is an incredibly delicate balancing act. If they hit the gas too hard by cutting rates, inflation could come roaring back. But if they keep their foot on the brake for too long, they could push the economy into a recession. It's a high-stakes tightrope walk, and their next decision is going to affect millions of us. The big question is, what's the right call?